So markets are doing great, but at the same time, we keep hearing a lot of tips from everywhere that one should invest in this particular scrape, one should not buy because there is blood on the street on certain days. Sometimes they say you should now keep jumping in the market because the markets may go to very high levels. So you get confused. So I have been investing for many years now and I have been hearing all this. So today I thought, let me share my experience, and maybe if this can help you in some way or the other, that the purpose will be served. So when they say greed and fear, it's very good to hear, but at the same time, is it that easy? So that's what I am trying to say. It is simple whether it is easy or not. How will we decide that what point we should stop? And once we sell our stock, the next day the stock goes up. And then we have that fear of missing out. And we again get into buying that same share again. And maybe this time we are not able to sell it. So is there a way out? Is there a way that we can handle this well? Is it that easy, or whether behavior of investors really matter? It's very difficult to sometimes see whether you want to have an egg today or you want to have a hen tomorrow. Because if you look at millennials, now the problem is that I keep talking to three different age groups. So maybe when I talk to a millennial, he will start with asking questions on crypto. If I go and tell him that you please invest for long term and buy a stock, let's say Britannia or a Pidilite, so maybe that doesn't interest him. He is looking for some easy game and he wants to make money immediately. Whereas when I talk to a person like my age who has seen investment over the years, he would probably listen to me. And then there are people in between. There are people who are young, although not millennial, maybe married with a kid, and they have their own issues, their own problems. They want to invest for their retirement. So the goals for all three categories are different. But what is common is that yes, there are 4 5 things which I would talk, which is required for this all across age groups, all three age groups. Obviously, one size fits all is not true. You would require a different prescription for different categories. So first of all, which I keep telling people and keep giving example, that you should have enough knowledge about asset classes, enough knowledge about what is happening around you. You should obviously little bit know about the news. At the same time, the efforts you put in to buy a TV or a mobile phone, probably that much effort you should put when you want to invest. I have seen many times, and I'm quoting an example, that when a family wants to buy a fridge, so the entire family will visit a showroom. They will look at different models, they will look at the color, they will look at the size of the fridge, they will look at frost free, not frost free, and whole lot of other features. Similarly, with mobiles, you will read review, or even you want to go to a restaurant, you will read review, lot of things, what kind of food is served there. But invariably, I have seen when you want to invest, the husband of the house or the father of the house or the head of the family would talk to someone he thinks has some knowledge about markets. and the kind of effort the entire family was putting to buy a 30,000 rupees fridge, he will take just 10% of that time, talk to one of his friend whom he think has some knowledge, and he will invest 1 lakh rupees. So that is what is investor behavior, and that is what the topic of my today's talk is, that how investor behavior suffers the investors, how the journey becomes not that great because you keep doing these mistakes. So when I say that you have lot of products today, whether you have that kind of a knowledge, whether, let's say, for an example, you want to invest in gold as an asset class, you say that okay, 5% of my net worth should be in gold. Now, do you know the choices? So obviously you can go and buy physical gold, keep it in your house, in your locker or bank locker. You can go and buy digital gold. You can go and buy a ETF, and you can also go and buy a sovereign gold bond. Now I have seen people talking to me about this choice, and I am surprised that many of my friends who are quite knowledgeable and well read uh, sometime will make some mistake. Even I was making that mistake. I was not looking at the tax angle and if there is an income possibility. So nowadays, if you are a retail investor, an individual investors, so SGB, the sovereign gold bond, is a clear winner because here is an asset which was never giving you an income. Now you are getting 2.5% income, and there is no capital gain if you keep it for 8 years. So it's a very simple thing. So that is what I am saying is, this is nothing but knowledge. You have read about it, you have understood this asset class, and now you are investing. At the same time, people will keep buying other options. So I'm not saying other options are wrong. Maybe initially we were buying ETFs, or it is easier to buy and sell because the liquidity is much better. So you should know the purpose of buying this asset. If you want to keep it for 8 years, then you can go and buy sovereign gold bond. If you want to maybe trade a little bit, get in and get out, you can buy a gold ETF. But yes, you should be aware of the tax angle. Or if you want to keep your family happy, maybe you can buy some jewelry and use it also, and it is an asset also. So everything has a positive, but at the same time, purely as an investment, purely as an income producing asset, maybe as SGB scores over other choices. So this is what the knowledge helps. At the same time, we always say that you should have goals, and everybody will have his own goal. A millennial would want to build some assets, maybe take some risk. A young guy would keep saving for his retirement, maybe around 35, 40 years of age, this person. And somebody who's retiring will already have some kind of a nest egg, but must be worried about falling return from FDs. So the goals are different. So for all that, sometimes you will need advice. You will need an advisor. You will talk to someone who knows this subject. I always keep giving another example that when you are sick, obviously you go and find a doctor. You always check that whether the doctor is good enough. You will ask some of your friends, if you have shifted to a new area, whether this doctor advice is good, and you will then go to the doctor, and most importantly, you will pay his fees, whatever fees is asked. You can never, and you may never negotiate the fees. I have never seen anybody talking to a doctor and saying, please don't charge uh, this much, please charge less. So that is it. But at the same time, when I suggest to some people that you have no idea about market, you are busy in your career, please go and take some advice, because you go to doctor for your medical problem or health problem, you should go to a financial doctor for your wealth problem. But more often I have seen that people are not that much willing to pay. And I have seen people who are willing to pay, who find the right advisor, are making much more money in the long run. So this is because at same time people think that it is so easy to invest, and nowadays in stock market everybody is making money, so that little bit of ego creeps in. So I keep telling that knowledge of your ego is knowledge, and ego of your knowledge is ego. If you remember this, you will always be there, and you will be seeking help from the people, from the experts, and you will be definitely ready to pay fees. So one should not confuse brains with the bull market. Nowadays everybody is making money. So there are people who are just lucky to make some money in this market. So there are two kind of people I have seen. First, who don't know, and second, who don't know what they don't know. They are not even aware that they don't know. So they are under this impression, yeah, it is easy. I am an expert. I will watch CNBC, or I will talk to some friends who keep giving me a lot of tips, and I will make enough money. So I think this is another area where one has to be very careful and seek help wherever you think that you are not qualified enough. Obviously, if you are a research analyst, and if you know little bit about stock, you do some own research, you can read balance sheets, you can read annual reports. So all this, if you know, I can definitely suggest that you should do something on your own. But at the same time, if you are not aware, maybe either go to an expert. And even for buying a mutual fund or an ETF, sometime you would require some kind of an advice, because sometimes people say that ETF you don't need any advice. But yes, there also is whether you should buy a small cap ETF, mid cap ETF, large cap ETF, what is the tracking error. So if you think that you are not an expert, please seek advice. Another problem which I have seen is that behavior of the investor is that they are attached to certain kind of investment. Either they would love a specific asset class. I have seen people buying property everywhere, maybe one plot in Delhi, one in Mumbai, one in Chennai, wherever he got posting during his uh, days when he was serving a particular organization. People keep buying asset, and then at the end they struggle to consolidate. So that is love for a specific asset. At the same time, financial assets are much better. They carry definitely least complication as compared to a house. You have to find a tenant, you have to look for someone who can repair, who can paint. Sometime you will have a problem with the tenant, all those things. So physical asset or real estate has these issues. Maybe, as I said, the first rule, the knowledge. If you have knowledge, maybe instead of buying a real estate, if you love real estate so much, you can buy a REIT, that is real estate investment trust. These options are available. But coming back to the attachment, so I have seen people, even in stocks, they would buy only one particular type of stocks. So I have seen people who will say, no, I can't buy expensive stock, I will buy a 50 rupees, 20 rupees, two-digit stock. But they forget to see that it is the amount of investment and the type of company rather than the price of the share. Again, this will come with the help of knowledge. This will come if you leave your ego. That was my first 2 points. And finally, if you have some kind of detachment. So you love your stocks, but your stocks, they don't love you back. If a company is doing great, as long as a company is great, you continue to hold that company. So we have seen over a period of time, there are companies where you have minted money, but over a period of time. But if not, you please diversify. Now, diversification also, you will hear a lot of stories. what is the right kind of diversification. So maybe if you have a concentrated portfolio, maybe you have 8-10 stocks, or you have a diversified portfolio, maybe you can go to 20-25 stocks. But if you are over 30 stocks, then definitely it becomes very, very difficult to manage. Even in mutual fund, I have seen people buying all kind of mutual fund with the similar profile. They will have three large cap fund, four mid cap fund, three small cap fund, some hybrid fund, and then maybe they will not buy debt, they will only buy equity. So you have to diversify, but what kind of diversification? Again, I keep telling, investment is simple but not that easy. So that is the question we have to keep asking, that it is not that simple. At some point of time you would require either a good advice, or you keep studying, you do your own research. So this is another area which I thought so first was knowledge, second I said ego, third I said attachment towards an asset class, and within the same asset class, maybe don't keep buying one sector. Na? Somebody is only buying, so sugar was doing well, the person continues to buy sugar. But these are cycles. Now IT is doing well, pharma is doing well, healthcare is doing well. Metals was not doing well for many years. Now metals are doing well. So if you have a good diversified portfolio, you would have done much better rather than having one specific asset class or specific sector or specific theme. Now, at the same time, there are people who are not happy with markets, who are not happy with their investment choices. Either they lost money sometime, or someone close to them lost money. So then they keep hating, they start hating stock market. They say, no, this is a gamble. I will never do it. I will never go close to stock markets. But that is also not right. Over a period, you will definitely make good money. If your choices were wrong, if you are buying penny stocks, or maybe if 2008 you sold everything and in desperation, or maybe last year when there was COVID outbreak, you sold everything in desperation, and that too at cheap prices, that doesn't mean that you will never make money in market. You have to come back, you have to learn. Sometimes these are the lessons which market will give you. It is stricter than a teacher or school will first charge you and then they give you lessons, but market sometime will give you lesson, and then maybe you start learning about that. So it is that painful, because your raw material here is money, so you have lost that. And sometimes people say, okay, I paid tuition fees, but if you are careful, maybe you don't pay that kind of a tuition fees. That's why even mutual fund, they say, do SIP, systematic investment plan. You can do systematic investment plan either in stocks or in mutual funds, because the idea is very clear here. If the market falls, you get higher number of unit if in an SIP, and if the market goes up, anyway you are investing less and your NAV is going up. So both way you benefit. It takes care of the volatility over a period of time. So there are many research which says that in 1 year the chances of loss is 60 to 70%, maybe 3 year it comes down to 40 to 50%, and over 10 year there's a negligible chance that you are going to lose money in market. So this is the hate you should avoid. You should not hate any asset class, you should not hate investing, you should not hate markets. You should be open, you should be ready to come back to markets, because there is going to be sale. If you are selling in desperation, then that is your problem. But let's say if you are buying good stocks, uh, for example, if I keep telling about this Fevicol example, because in my entire life I have seen everywhere in building material that everybody wanted Fevicol only, and I could not find any other adhesive. And if somebody is buying this kind of companies, obviously a disclaimer that you should ask and you should do your own research. But this is for an example, and this stock is doing really well over the years. Every 3-4 year it doubles. But it is so boring. Sometimes boring investments are very good. Whether you can see lot of such stocks which keep growing in different sectors. So you know those stocks, you have heard those stocks. There are stocks which people say that have not performed for the last few years. Nowadays, an FMCG stock, everybody is worried whether it is going to perform or when it will perform. But at the same time, whether you see the business growing, yes, if that particular company's product you are using, if you are doing all that and you looking their numbers, their profits, so maybe at some point of time a great company will become great again, because you are only looking at stock price, you are not looking at business. So sometimes these are the people who are sitting on these companies will definitely make more money. But yes, the patience is required. In stock market, they say the money moves from an active to a patient investors. And finally, people are always worried about markets, and people always look for a linear kind of return, that every year I should get some 20%, 30%, 15%. But market will never do that. In one year you will get 30%, next year you may get 5%, third year you may lose also, fourth year again you will get 30%. But over a period, over 20-year period, over 15-year periods, you will definitely see the number which you are aiming. And be reasonable, don't look at 25, 30, 40%. Maybe nowadays, if you are getting 12 to 15% CAGR, that's a good enough return. Some years you will be lucky, some years, like people who invested last year in 2020, last 1 year has been great. Even the ETF has given you great returns, because market fell 30% and after that it has gone up. So if you have a new entrant last year, you are very happy. If you are if you have sold something, you are not happy. If you are added something and you are a old investor, again you are happy. So this will continue. uh, Important point here which I always tell people is that you should have the right kind of margin of safety, because when you buy, I think you make 50% of your money. Buying cheap is much better than selling at a particular price. If you are buying at the right time, that's why I keep telling my friends that every year or every second year you will find the market is going down by 10%, 50%, 20%. That is the sale time. That is where you build your margin of safety. Maybe you keep noting down a list of stocks which you will buy in those times, and when the sale happens, go quietly and buy. But again, I have seen most of the people are fully invested, and at that time, in the early days of sale, maybe 1 or 2 days, they'll go and buy good number of stock. But at some point of time, they will not have any funds, and for 1 month they will keep looking at the stocks and keep repenting that I should have kept some money. So that is why I tell people that you should save money for these kind of markets. And even Warren Buffett once mentioned that it is very painful to have that money and do not invest, because you always tempted. Like last few months have been great, and I have seen most of my friends are fully invested, and many of us keep doing that mistake again and again. And whenever the bear market comes, as I said, I have been investing for 30 years now, and every time a bear market has come, at some point of time in the bear market, I was thinking if I could have got some more money to invest. Every time I keep learning, and I keep some money aside for these kind of days. Then I think you will get that alpha, you will get that extra kick from your investment returns. And another thing is that for millennials, I will advise, okay, you are young, you want to buy different kind of asset, you want to experiment, please do. You want to trade, please do, but learn that. If you want to do trading, learn technical trading. If you want to do derivative, learn that. If you buy risky assets, keep some small portion of that. At the same time, I keep telling people who are in midlife, who are 35, 40, because I am in touch with many of such people. So I keep telling them that start building a passive income stream. Start building income producing assets. Maybe if you are buying stocks and there are two stocks which are growing at the same time but are giving good dividend also, so over a period of time you will have a passive income. Maybe if you are going across asset classes, you may have maybe an extra house, and if you are earning some rent, you can do that. You can put some money in debt, you'll get some fixed return from that. And instead of buying more houses, you can buy REIT. And nowadays, other option like InvITs are available. Maybe some other day we can discuss more on these asset classes where you get much better return than FD. The trade-off is, yes, you are little bit worried sometime the principal may go down, but at the same time, if you are not earning good return from your asset, that also is a risk. So there are two risks. One is the permanent loss of capital to some extent, and third is there's a low risk asset that your investment may come down, but the income probability is much higher. So you have to have a balance between these two extremes. I'm not saying that you should do it all the time. Depending on your liabilities, depending on your age bracket, depending on your risk profile, you should take a call. The younger people can take obviously better risk, but at the same time, I have seen a young guy who has got someone at house. He has got three sisters who get married. He has to support his parent, or a retired guy or a guy in 50s has no liabilities now. So the risk profile of that 50-year-old guy is much better. So again, never go by only age when you look at risk profile. Actually, at the end of the day, I say that there is no foolproof strategy for anything. We are all learning the game. At some point of time, we realize that this particular theme will work, this particular strategy will work, but we always keep getting new ideas and we keep trying. As long as you don't lose money, you don't lose much money. Again, the rule number one, which you also would have heard, never lose money, and rule number two is look at rule number one. So if you can avoid losses, big losses, even if your some of your ideas work in your lifetime, if there are 15 big ideas you tried, and if only 4 or 5 work, you will make decent wealth, and others did reasonably well, maybe one or two you lose some money. So I think losing big money you should avoid. That is what you should be approximately right than precisely wrong in a particular decision. If you know very clearly that this is going to be very risky, you can leave that. So I think you have to do that much risk and that much study. At the end of the day, enjoy the journey, because most important is the journey. That is what I have noticed over the years. The journey is very important. You will do reasonably well if you are approximately right, maybe 90% of the time or 80% of the time, and you don't do blunders in your life. That avoid those blunders and diversified. I said you can diversify nowadays. Another diversification which is advisable is the global investing. Now you can do it in different way. You can buy directly. You can buy a Indian mutual fund product where they invest in foreign or global equities. So diversification in different asset classes, different sectors, buy stocks of different companies, some FMCG, some IT, some pharma. So you can keep doing. Do in moderation. Don't be attached to a specific theme that nowadays if metal is doing, my 80% or 70% of my portfolio is metal. That is not the right thing. So you have to keep revisiting your strategy at all point of time, and you will do well. And people who are my age, I have seen, they have got enough coppers now. At the end of the day, you should enjoy life. You should look at other areas. You can travel, and you can give back. You can talk to youngsters, because we always have one feeling that if I would have been wise enough in 2008, I would have avoided this, or if I would have been wise enough in 2000, because we have learned that lesson. If we can teach others, if we can talk to others, that's why I said the market will first take everything and then you learn the lesson. So maybe if you can help some people that they avoid this kind of mistakes, that is going to do well. So maybe in the end, let me close this. The theme obviously is that it is simple. There are a lot of things will people will tell you it will look so simple on the paper, but it is very complex, and it is complex because of our own behavior. So keep looking at our own behavior and avoid this emotions of too much love for stocks or a specific asset class, too much ego, not taking any advice, too much fear that we are going to lose money. So all this emotional thing, if you are aware, if you are mindful of where you lack, there are people who can't book losses, who can't put a stop loss. So maybe technical trading is not for them. Accept that. So that is your own risk profiling you are doing. But if you know that you are very swift, you are very agile, you will put a stop loss, you can do some trading. If you can't, then buy good stocks and keep sitting over there. Buy more when there is a sale. So, as I said, there is no foolproof strategy. We will keep learning, we will keep sharing, and this medium, I will be there to share my thoughts. And let me thank Pickright for this opportunity. Pickright is also a platform, wealth stack platform, where you can go and invest in different asset classes. The right kind of advice you will get it. So I think these are some of the new age wealth tech platform where we get that kind of a help. Because one thing which is very important, which is coming out of this entire exercise, is that you need some advice unless you yourself are a research guy or part of this. But let us be very clear, we think we are better than average. Most of us are not, including me. So let me close here. See you next time. Thank you.